There. Let me get my pen.
Almost there.
Is this going on? I'm gonna put them on. Is this going on your personal page or the Blueberry one?
Actually, my personal, then I'll share it probably.
Oh, that's a good idea. Yeah.
Because more people know me than Blueberry. Hope it's happening. I think it's working on it. Come on. Well, this is a little more complicated than I thought. Oh, here we go, go live. Well, I guess I should have started a little sooner. They made it sound super simple from the YouTube. Hey everyone, this is Jennifer. And I hope this is working right. So I think it's working. At the very least, we're recording, so that's a good thing. So with me is Loretta. I am Jennifer Granigo. I am with Blueberry Realtors, Keller Williams Harbortown in Holland, Michigan. And I have Loretta, and you're gonna have to say your last name, Loretta. I wanna make sure.
Loretta Chetkovich.
Chetkovich, all right. And she is with Team Mortgage. And we want to ask her some questions today. There's so much surrounding home buying. And I've been talking to a lot of renters lately, and they just don't think they can afford to own a home. And I know you have personal experience with this. And I just thought you could, what can you say about that to renters out there?
It's always discouraging. And when you start doing Google searches on how much money do I need to save to buy a house, it's always discouraging. Generally, it says you need 20% of your loan amount, plus, I mean, for down payment and closing, and you need a really high credit score and a lot of things. And actually, the market is really pushing and to make sure housing is affordable for you. There's a lot of federal guidelines set by the government in terms of how mortgages are written to make sure that you're not only protected from any kind of predatory lending, but you are also able to afford it. They keep the guidelines to make sure people at a median income can afford a home. So really what you need is your down payment, and then there's the closing costs, but you can get seller concessions to cover the closing costs.
What does that mean exactly?
Oh, seller concessions. Yeah, this one, it's so funny. Like when you understand it, it seems obvious, but sometimes it's hard to understand what the seller concessions are. So there's a part of the sale right near kind of the end of the form, where the seller can volunteer to give part of the proceeds that they're getting. They can actually, what they do, the concessions are when they're giving X amount back of the proceeds into the loan, that is a credit to you.
Right.
So the buyer. So you can, seller concessions are very common. You're more likely to be able to get them in a low point in the market. When at a higher point in the market, what I find, and this is probably something you know more about, Jennifer, but they're harder to get because sellers know that someone could come along that doesn't need seller concessions.
Right. Like right now, the market, there's just not a lot of inventory. There's not a lot of houses out there. So it's really kind of a seller's market, right?
Yeah, yeah, it is, and that's another discouraging part. But I mean, I just had a buyer. They had their offer accepted on a home today, and they're getting we have a zero down FHA program.
Oh,
Plus, they're getting $4,000 in seller concessions.
awesome.
So they're going to need to bring about $900 cash to the table. Plus, they need to have a certain pool of assets that the lender wants to see that in their account after closing. But they're really only bringing $900 cash to the entire sale. So.
That's fantastic. You could think most of us could save that amount of money, right?
Yeah, yep. And they're being helped. They do have a decent credit score, meaning it's between 650 and 700. So that's a decent credit score. They have no other debt as well. So they've been able to keep their debt to income ratio within good parameters for their loan too. So that's helping them. But,
right.
Yeah.
So when you first talk to someone about their credit score, I've talked to somebody who doesn't have a credit card, to people who are paying off medical bills or student loans. Sort of how do you guide them through the process of getting them ready to buy a home?
The first thing we do is if they aren't sure what their credit is, and everyone has access to a free credit report. You do not have to pay Credit Karma for your report. You can go online to it's either My Annual Credit Report or annualcreditreport.com. You can check out your credit report. But if you haven't done that and you want me to look at it, our company does a soft pull on your credit. So that means that it's just a look into the credit and it doesn't get reflected into the credit report. A hard pull gets reflected and it can take a couple of points off your score.
So when I go look at my credit card score, my credit score myself, does that hurt my credit?
Oh, no, not if you look at it, you can look at it as many times as you want. It's your credit report. You don't get nicked for that. Yeah. So that,
if you do a hard pull, my understanding, I just heard from another lender that if it's within a certain time frame, that each of the hard pulls doesn't count towards your credit. Is that?
They get on there. Every hard pull is shown on the credit report, and then if it's done within a certain time frame, a couple of them don't count. But if you definitely spread them out, if you have like one every, if you have one and then the next one 30 days and another one 45 days, that starts hitting it pretty hard. Yeah.
Okay. So you talked a little bit about down payments. Now, when I'm a veteran, so for the majority of the houses I bought, I've been able to use a VA loan.
Mm-hmm.
And so I didn't have to have a down payment. I've always heard it's 20%. And depending on the cost, the price of the home, that can be pretty steep.
Yeah. And I think it used to be 20%. But what they've done now, they invented this thing called mortgage insurance. So most conventional loan requires 5% down. And then a conventional loan for a first-time home buyer actually requires just 3% down. Okay. So that's a great program. It's called a Home Possible or a Home Ready Mortgage. And that's 3% down. FHA loans are 3.5% down. And those are standard. And then you've got the VA loan with 0 down. You've got the USDA loan also with 0 down. And then other programs like the one I use a lot, the FHA 0 down through a certain lender. But
very nice.
Yeah, so it's important to know though, if you're putting down less than 20%, you get slammed with the mortgage insurance. That's how the lenders they use that to kind of insure themselves against defaulting, making sure that, if you have to foreclose on the home, that they're going to recoup all of their investment. So you do pay until you've paid down your loan to value to 20%, then you have to pay this kind of expensive mortgage insurance bill every month.
Okay, and it's on top of your mortgage.
Yeah, yep.
But can you refinance then after a certain time?
You can refinance if you know that your home value went like more in the last couple of years, which always has happened, I think, to anyone here in Michigan. Then chances are that your loan to value has hit about 80%. Just without you actually paying down more money, the other side went up. So
Right.
it's worth looking at for sure. And that a lot of people actually are. We're having a huge influx in refinances for that reason, and because right now the rates are incredibly low too.
Right.
So
Which is so nice. Do you have anything to say on rates? If people are waiting to buy, what would you tell them?
right now everyone's predicting it's going to stay good. We were all kind of afraid that after the election the rates were going to start going up, but they didn't. They stayed the same and have been actually plummeting. They're lower than they were in July even.
That's fantastic.
As far as I know.
that
I don't,
that was my understanding too, but I figured
yeah,
that.
it keeps getting lower, and people are thinking it's either going to stay as it is or go lower, but it's not. If it goes higher, not not remarkably higher.
So there's a lot of other upfront costs. The down payment people are ready for, but I don't know if they're ready for all the other costs that they have to present. There's escrow, which again would go into their closing costs or down payment. There's inspections, administrative fees. So when somebody has a max budget, do you talk them through that? Like what they might not want to go to their max unless they have a lot saved?
Yeah, we go through we have to calculate the full fees sheet as part of their pre-approval. So we go and we estimate everything high. So we estimate a really high homeowners insurance payment that they're going to be making. We estimate kind of the higher tax bracket range they might end up being in. We estimate high fees on. So you get pre-approved on like a worst case scenario kind of fees.
Right.
And so we look at that, and it's important to know that the lender fees, any commission you're paying your mortgage lender actually is not even on your fees worksheet. You don't pay our commission actually, so that's not part of the fees. It's kind of good to know actually, and I like that as part of when I make the fees. I'm not actually charging my fee unless you're paying discount points. I have to put in that, but that's another problem. Discount points are too complicated. But it's important to know that generally your lender closing costs are going to be about maybe $3,000 on about a 150 or less kind of loan. So all the other closing costs are your city and county taxes and your homeowner's insurance, and not just what you have to put in escrow, but an entire year, your entire mortgage insurance premium has to be paid up front. So that's sometimes $1,200 straight out of your pocket.
Right.
So I mean, it helps to know it's not like a bill or anything. I mean, well, it's not a fee. It's a bill you have to pay anyways. But
right.
Yeah.
Okay, good. Is there anything else that you want new home buyers to know about the process and how to work best with you?
That it's not, yeah, it requires less money than you probably think it does. Your credit score, if you've got at least a 620, I would say go for it. You can get decent rates, especially now on a 620 credit score. Paying off debt is not necessarily going to help your credit score, but it will help a debt to income ratio. So you want to balance between that. If you want to go for a better credit score, or if you want to go for a higher loan amount, that you'll need a low DTI, debt to income ratio, with that. So yeah, sometimes I've seen people pay off their loans and then their credit score goes down. So be careful with that. If you're really trying to build your credit, make sure you're working with a credit professional of some kind who really understands what you should be doing to build that up.
What about getting a new job, buying a new car?
Yeah, try to not buy any cars. I mean, and I hated hearing that when I first graduated college. I bought my own car, And I heard from many people like, don't buy a car, it's a buying expense. And I'm like, well, I want a car, but if you can avoid financing a car, that's what I see on people's credit history is, first of all, the student loans are always, they're always on there and they're always going to be ruining your DTI, but everyone's got student loans. So if you can avoid piling on long-term financing like cars, try to do that. Just stave it off until you've already purchased your first home and for the loan amount that you were looking for.
Right. Good.
Yeah.
Well, I appreciate this, Loretta. I appreciate you coming on. I know you've had a hugely busy week. So I appreciate you talking to all of us today, and I'll have this recorded and I'll send it to you as well. And hopefully we can get it posted on Facebook. I do think we're live. So I think it worked. My first Zoom live on Facebook. So we'll see what happened, but have a wonderful evening and we will talk to you soon.
All right, you too. Thank you so much, Jennifer.
Thank you. Bye-bye,
Bye.
everyone.